So, welcome to today's presentation. My name is Peter Joseph, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame, unless otherwise stated. First thing we note is definitely we need some changes here. The S1 was broken, but the index seems to be stabilizing. It's characteristic that that the downward trend line guiding it seems about to be interrupted, yet the bearish tendencies are still there. So let's start with correcting the resistance line and turning it into support line. It's the 99.8 in red, please. Let's go hunting for a new ultimate support line, unlocking the chart, going back. A nice throw here, a little bit wide, but I'm keeping it. Green. And that would be the 96.65. Yep. Readjusting. Let's reposition the labels and correct them actually. Placing a new R3 label at 101.60 in red. The R2 to be placed at 100.60, 100 pips lower. The R1 at 99.80. The S1 at 98.80. The S2 at 97.75. And the S3 at 96.35.65, sorry. Let's reaffirm that. Yep, that's it. Locking everything in. For the time being, the bearish tendencies seem to be maintained. Despite the stabilization over Friday, some even slight gains. The RSI indicator remains below the reading of 30, also highlighting the bearish sentiment in the market for the index, for the US dollar. So the selling is still not quite over. Should the bears maintain control, we may see the US dollar index dropping, breaking the 98.80 support line, and start aiming for the 97.75. On the other hand, I wouldn't be surprised, given the stabilization and the slight gains on Friday, to see the index stabilizing, breaking the downward trend line guiding it. And that would be a clear signal that the downward movement has been interrupted. And in that case, we may see the index stabilizing between the R1, 99.80, and the S1, 98.80. Something like this. Should the bulls take over, I would expect once again the price action to break the downward trend line, but also break the 199.80 and start aiming for the 100.60, nothing less. Now, on the fundamental side, it's going to be a quite interesting week. And there are two reasons which highlight, actually three, which highlight this interest. The first is that we have a lower number of high impact financial releases stemming from the US. There are still some, but they're far, far fewer than last 2 weeks. So that's one element. The second element is that given the easing of inflationary pressures in the US economy, both on a consumer as well as on a production level, producers level, the attention now turns towards the Fed. And the Fed's meeting is scheduled for the 26th. That should be next week. On the other hand, though, exactly because the meeting is on the 26th, no statements are allowed by Fed policymakers. There's a moratorium of 2 weeks. So the market tends to remain, partially at least, guideless. For the time being, the market expects the Fed to continue hiking, at least for the next meeting, and actually remaining on hold after that until the end of the year, and start cutting rates possibly near the end of Q1 next year. So it's a quite interesting view. On the other hand, though, we had Fed policymakers in the past 2 weeks more or less reiterating the need for more rate hikes, with some even citing that 2 more rate hikes would be required. So there is a divergence between what Fed policymakers are actually saying, i.e., 2 rate hikes more, i.e., 1 in July and 1 afterwards, and what the market expects. The market expects 1 rate hike in July, and from there on, sideways, or if you prefer, standing on pad. It's going to be quite interesting, and I think that today's American opening may provide us with additional clues, especially about US stock markets. Don't forget that we have the earnings season in full swing, and may I remind you guys that more or less we expect a shift of attention of traders from the FX market towards US stock markets. We had already the releases of a number of banks on Friday, including practically Wells Fargo, JP Morgan, Citigroup, which more or less tended to be better than expected, both on a revenue level as well as on an EPS level. So that's an issue, which on the one hand is a positive signal that the banking sector is still resilient despite the tight financial environment in the US. On the other hand, though, the market expectations weren't that high. So it wasn't so difficult for banks to be able to surpass market expectations in the last release, practically on Friday's release. So I'm not quite sure about, I wouldn't say the resilience, but definitely the health of US banks just yet. In the coming week, okay, we have a rather easygoing Monday, but I would be noting the releases of Morgan Stanley. I would be noting the releases of Goldman Sachs. That's on Wednesday. Of Netflix, Tesla. both of them also on Wednesday. We have a number of other releases as well, but it's going to be quite interesting. I would be highlighting especially Tesla. We had for Tesla at the beginning of the year a new record number of sales for the past year. The company delivered, if I'm correct, the highest number of vehicles in the quarter in its history. On the other hand, let's not forget that for the company to be able to get those sales, it had to provide discounts to clients. So that would mean more or less some pressure on the profit margins. It's going to be interesting to see how that reacts on the EPS figure. Okay, let's have also a look at Euro USD. Euro USD, which has jumped and stabilized, reflecting practically USD's rise. Once again, let's correct this at 1.1185. And definitely it has to be turned into support line. Let's go hunting for a new ultimate resistance line. This is a nice peak here. A little bit narrow, but still nice. I'm keeping it. And that would be in red. The 1.1490. Readjusting the chart. Let's reposition and correct the labels, starting with the S3, which is now being placed at 1.1010. The S2 at 1.1090. The S1 at 1. Give me a sec. 1185. The R1 at 1.1275. The R2 at 1.1395. And the R3 at 1.1490. Okay, let's talk about the trend. Definitely the upward trend line has been shifted to the right, widening its angle a little bit. That's it. So the upward trend line still remains. Albeit we have to note that the steepening has ended. You can see it here. There was an upward movement starting to form an upward trend line, yet later on the slope of the upward movement suddenly steepened substantially. Now exactly this was becoming more evident. However, that has been broken and the pair has stabilized somewhat. The question is whether the second support line will be providing the necessary push higher. For the time being, the pair, let's zoom in a little bit, seems to have stabilized. So we tend to maintain a bias for a sideways motion between the S1 and the R1. We note though any bullish tendencies and we highlight them not only due to the upward trend line here, but mainly because of the RSI indicator, which remains above the reading of 70, implying a strong bullish sentiment in the market. So the bulls have not given way just yet. Should the bulls maintain control, I would expect the price action to break the R1 1.575 and start aiming for the 1.1395. On the other hand, should we see stabilization of the pair, we may see it testing, if not even breaching the R1 1.5, testing, if not even breaching the upward trend line we have mentioned, remaining between the R1 and the S1 in a sideways motion like this. Should the bears take over, we may see the price action dropping, breaking initially the upward trend line once and for all, signaling that the upward movement has been interrupted. But I would require also the pair to drop below the S1 1.1185, with the next possible stop for the bears being the S2 1.1090. Now, on the fundamental side, I would be highlighting definitely the fact that European stock market started on the back foot. So that seemed to be an issue. I would also, though, expect the market worries about, because you have to understand here that many traders in European stock markets worried substantially after the release of China's GDP rates. They were for Q2. They were lower than expected, albeit we had some positive surprises as well. So, for example, the industrial output growth rate accelerated more than expected. That was a positive. But overall, there seems to be additional need for more, I would say, assistance on behalf of the People's Bank of China and the Chinese government. More stimulus may be required here. Nevertheless, Europeans have their own issues to worry about as well. Definitely another rate hike is expected by the ECB in its next meeting, which is also next week. And now there are some conflicting messages about a rate hike after the summer. Say, for example, whether ECB will be hiking in September again or not. That's an issue. It's, in my opinion, a rather tantalizing issue, despite the slowdown of the CPI rates, etc., being verified, and the market expectations for an easing of the ECB's aggressive stance. May I remind you that in Germany, which is the main economy of the Eurozone, the inflationary pressures are still high. The HICP rate there accelerated. And I would expect Germany's Bundesbank president, Joachim Nagel, to exercise more pressure for a more hawkish view on behalf of the ECB in its next meeting. On a more macroeconomic level, we tend to remain quite worried about the outlook of the German economy, especially given that the German economy is strongly manufacturing oriented, and manufacturing has been experiencing contracting economic activity over a number of months now, continuous months. And that may slow down, if not even contract, the German economy as a whole. Should that happen, then we may see chain reactions in the Eurozone, across the Eurozone actually, in various other economies as well. It's a big issue, and I think it tends to pass under the radar on an international level. In Germany, of course, they're worried, but on an international level, it does not seem to be getting the headlines it deserves. Once again, for the time being, I expect the pair to remain USD-led. Maybe there will be some independence from the euro side should there be a big surprise in the preliminary consumer confidence of the Eurozone, if I'm correct, tomorrow Wednesday. it's another issue which is quite interesting. Okay, let's have a look at cable. Zooming in. It's the forward chart. We have quite narrow levels. Let me reposition them. We are very, very focused in cable. It's a very interesting pair in the sense that there is a high sense of urgency on both the GBP and the USD side. Market reactions tend to be a little bit more risky currently, or be more evident in GBP USD rather than other pairs. And we see that intensifying even further when we move to commodity currencies, which are considered to be even riskier. For the time being, we highlight the breaking of the upward trend line, which was guiding the pair. That's clear here. There's no question about it. And we expect a sideways motion to prevail, possibly between the R1, 1.3145, and the S1, 1.3040. At the same time, I would be noting that we have an RSI indicator which has dropped below the reading of 70 and actually still dropping, even at a slow mode, but slowly but steadily dropping. So that could allow, in my opinion, the sideways motion to be maintained here. Should the bulls take over, I would require the pair for bullish outlook to break above the R1 1.3145 and start aiming for the R2 1.3225. On the flip side, should the bears take over, we may see the pair dropping, breaking the S1 1.3040. Next possible stop for the bears could be set at the S2 1.2940, 100 pips lower. Now, on the fundamentals, beside the US fundamentals regarding the pound, I would expect pound traders to place considerable weight on BOE's monetary policy outlook, and the bank seems to continue to hike without hesitation. It's understandable given that despite a slowdown of inflationary pressures in the UK, the CPI rate remains unacceptably high. It's characteristic that UK CPI rate on a year-on-year level, it's still at 8.6%. If I'm correct, that's the highest level among developed economies. It's a big issue, and BOE has no option actually but to hike rates. Hence, I would be also placing considerable weight on the release of UK CPI rates. I think that's on Wednesday as well. It's expected to slow down from 8.6 to 8.2% year on year. I would like to remind you the statements made by BOE Governor Bailey. He stated last week that he expects inflation to come down markedly over the next months. Now, dropping from 8.6 to 8.2, you don't exactly name that markedly. And mind you that BOE has made wrong predictions about the CPI rates a couple of times. So it's a little bit worrying here. Should the UK CPI rates, especially on a year-on-year level, slow down less than expected, even tiny bit, say for example from 8.6 drops to 8.3, 8.4, not to mention the possibility of rising, I would expect the pound to get some substantial support. That would be higher than the market's expectations and could provide some support for the pound. Why? Because it would enhance, or if you prefer, sharpen BOE's hawkish rhetoric and hawkish intentions. It's a big issue, and I think UK CPI rates along with UK's retail sales on Friday are going to be interesting releases, trading-wise. Other than that, I would be noting on the monetary front, we have BOE MPC member Ramsden. I think he's scheduled to make statements tomorrow. And should he sound somewhat hawkish, we may see the pound getting some support. Okay, let's move now to USD-JPY. Also a very interesting pair. Definitely we need some corrections here. Would be highlighting this as the new resistance level. 139.10 in red. And as a support line, correcting it a little bit lower. 137.25. We need to go hunting for a new ultimate support line. I would be highlighting this double throw here. Once, twice. Quite interesting. $133.75. Sorry, in green that should be. And let's widen the R1, R2, sorry, and the R3. Placing it on this peak here. Also some resistance here. As for the R2, it's I think quite obvious. We have a double peak here. 140.90. 143. Let's readjust it. Okay, let's place the labels. The R2. 140.9 if I'm correct. Yep. Now, the elements here which are in play are definitely the initiative on the US dollar side. But I would be noting on a more fundamental level also the ongoing rumors about a possible tweak of BOJ's dovish monetary policy settings. There are a number of analysts which highlight the possibility that BOJ may be tweaking its ultra loose monetary policy in its next meeting. I'm not exactly one of them. Now, the discussion was whether the bank's going to be altering, or if you prefer, widening the tolerance levels of its YCC policy, yield curve control policy. That would mean practically that the bank would not start buying Japanese government bonds once its yield has surpassed 0.5%. Yet I would allow it to fluctuate possibly a little bit higher, maybe to 0.75 or even 1%. I would expect the bank to leave it as is. And if it's going to be altering it, it may be taking them out altogether. On the other hand, we have a quite sensitive situation in Japan. And that's something which the bank may not want to risk altering, or at least may not want to add more uncertainty on that. So we may see the bank actually maintaining its ultra loose monetary policy settings in place. A possible tweak would definitely support JPY and cause USD JPY to drop far lower. But given the wide correction which the pair has presented since around the mid of July, we actually, let's have a look which date. Sorry, since the beginning of July, 6, then I think that's no longer necessary. USD JPY was able to correct far wider than other FX pairs. Let's zoom in a little bit. You can see that we had a drop of around, let's have a look how long. 740 plus pips, which was pretty wide if you consider the narrow span of the market reaction. It was made practically within 5 days, working days. Nevertheless, the strengthening of JPY against the US dollar, if you prefer, the weakening of the US dollar against the JPY, seems to have hit a hold at the 137.25 support line. Let's readjust them a little bit. But interestingly enough, the pair failed to actually break above the 139.10. It respected it, despite bouncing on the S137.25, breaking the downward trend line, guiding it. Okay, this is of no use. Let's delete it. And has stabilized. So for the time being, we tend to maintain a bias for the sideways motion to continue between the R1 and the S1. The RSI indicator was finally able to break above the reading of 30, implying that the bearish sentiment of the market for the pair has eased. On the other hand, though, it remains at quite low levels. It's currently at 36.7, which, okay, still mentions or still implies that there is some bearish tendencies among market participants for the pair. But for the time being, I think sideways would be the proper direction. Let's not forget, bearish tendencies could reappear in a given moment. Should the bears take over, we may see the price action breaking the S137.25 and start aiming for the S235.70. On the other hand, should the bulls take over, I would require no lower peak than this one. I would require the pair to rise, break the R139.10 clearly, have its next peak somewhere here, and start aiming for the R240.90. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello everybody and welcome to another one of our great videos. Today we'll be looking at how to practice discipline in trading. Discipline is a necessary and important part of any trading strategy. Without discipline, a solid trading system and proper risk management lose their value. Self-discipline involves developing a mental framework which enables you to stay motivated and focused. You should have a target or goal in the mind, as this is the first step towards developing self-discipline. Discipline can be mastered, and all you need is willpower. This involves carefully studying the markets, and especially the markets you're trading. In order to acquire discipline, you must practice patience and be able to control common emotional impulses like fear and greed. Proper discipline involves having and sticking to a trading plan. Create a schedule for your trading. Know what signals will make you enter or exit a trade. You create trading rules to get you out of trouble when positions go badly. If you don't follow the rules, you've lost your discipline and allowing for even greater losses. Ensure that you apply proper risk management by sticking to your stop loss and take profit orders. If you stick to the rules, you will discover that discipline is necessary for success. Thank you for watching.
Okay, welcome everyone to today's session. Today's session, we're going to touch on Fibonacci confluence, right? Particularly the Fibonacci confluence trading strategy. As the name suggests, right, confluence means there's not only one level there, but there are multiple Fibonacci levels that line up exactly there, right, to create a high probability reversal zone. Okay. Now, as usual, remember, if you have questions, don't hesitate to ask it anytime throughout the webinar. Right, I'll do my best to get to them, right? And of course, to begin, right, risk warning. Remember that everything in this webinar is educational in nature, so please do your own little due diligence before you guys trade. Nothing should be construed as investment or trading advice. Okay. Now, so for those of you guys who do not know who I am, my name is Desmond Leong. I run the award-winning research firm Everest Fortune Group, also a Forex Army, right? I'm finalist for the best FX and best equity research in 2019, 2020, and 2021, right? So recently been taking a couple of prop firm tests too, right? I think my Forex funds is the most recent one that we passed, right? And yeah, you know, it's today's webinar will focus on the Fibonacci confluence trading strategy and how I actually use it. All right, it's a reversal strategy. Okay, it's a reversal strategy, so it works really well when in overbought and oversold situations. But you do need to have a lot more confidence when you use it, right? Meaning that it's usually against the market. So if I have my pen over here, right? And my pen over here, usually when you're taking a reversal trade, you know, the market is going against you, right? It touches and then it reverses. This is what we call a reversal kind of contrarian style of trading. Is slightly different, right? So it's not the usual breakout trading. So most people are comfortable with a breakout trading, means that price breaks out and they play all the way down, right? This is because, you know, when price is dropping very strongly, you feel a little bit more comfortable trading the direction of price, right? But the Fibonacci confluence trading strategy is slightly different, right? It actually plays the reversal, right? It actually plays the reversal. That means you need to have a little bit more tolerance for risk, right? Especially when you see prices coming down and then you choose to play in the opposite direction. Okay, it's a lot scarier, right? But it can also be a lot more rewarding because you can get a pretty good risk to reward. Okay, now let's begin today's session. Right, I'll be touching on a couple of things here. Questions, remember to feel free to send it through directly to me. Send it in the Q&A part. I'll do my best to answer them. Okay, let's begin today's session. Okay, so let's first touch on ideal market structure. Okay, ideal market structure, right? So this is the part where okay, there you go. When you're trading Fibonacci, right? When you're trading Fibonacci, right? One of the things that you want to do is you want to look for ideal market structure, right? You don't want a market that is too is like too messy, right? You want to look for the markets where there are very, very clear movements, right? And this is what I mean by that, right? You need the markets with very, very clear movements. You want to look for the big movements. You don't want to look for the small movements like this. Okay. Now, let's of course move on from here, right? There are two things that you need to take note of when it comes to drawing Fibonacci, which forms the basis of our entire trading strategy, right? When you draw Fibonacci, you'll notice that there's this dotted line that goes all the way through when you're drawing it. This dotted line needs to follow price as closely as possible, right? It needs to follow price as closely as possible to be profitable, no, to be accurate and relevant, right? So in this example, when price is like moving in this direction, the Fibonacci retracement is not very effective because price tends to deviate quite far. Price tends to deviate quite far from the dotted line. You compare that with this. When you draw a Fibonacci retracement like this, from here to here, you notice how nicely price follows it, right? Even from here to here is okay, right? It deviates just a little bit. In these kind of situations, the Fibonacci is a lot more effective because it follows price more accurately. Okay, so that's the first two things that you need to take note of about market structure. Okay, that's the first two things you need to think about when you're drawing Fibonacci retracements. Your retracement should ideally follow price structure as closely as possible, because only then will it be can you get an accurate Fibonacci retracement. So I just need to drink a bit. My throat, oh shucks, my throat is hurting a bit, so I do excuse me if I take a couple of sips here and there. And of course, when I accidentally spill it on my mouse, oh god, just give me a second. Okay, now let's continue, right? So yeah, this is the correct way. Now, a Fibonacci, let me explain to you what's a Fibonacci retracement, a Fibonacci extension, a Fibonacci expansion, and a Fibonacci projection. Okay, there are four different things, and they are used differently. So if you know how to use them, that actually unlocks the secret to trading. If you ask me personally, right, unlocks the secret to trading if you know how to use this properly. Okay, so for example, Fibonacci retracement, you only pick one point and you pick a second point. Okay, when you pick 2 points, you then be able to your starting point and your ending point. You are trying to see how far price will then retrace upwards. Okay, so you tend to have a few traditional 23%, right? 38%, 50%, 61. This basically means like how far you're retracing. If you retrace 50% of the entire move, that means if the total drop was 100 pips, right, and you retrace 50% of the move, it means that it's a 50 pip, price has moved back up by 50 pips. Okay, so that is basically what it means by Fibonacci retracement, right? 23, 38, 50, 61, all these different numbers, it basically is simply, right, the percentage of the move, right? So if price comes down and drop all the way here, if it bounces up by 50%, it basically means that it has retraced 50 pips, right? Assuming the drop is 100 pips. And if it retraces more than that, right, this is the 61, this is the 78, right? It basically means how much of the original movement it is recovering from. Okay, now the next thing we do is Fibonacci projection. Fibonacci projection is a little bit more complicated, but it basically means you see the starting point here and the middle point. Okay, you are taking the distance of the starting point to the middle point, right? You're taking the distance, like let's just say the distance is 100 pips, right? And you are projecting it onto here, which is another 100 pips, right? So that is what it means by 100% Fibonacci projection. Okay, it means that you're looking for price to touch and then bounce from there. Okay, we are looking for price to touch and then bounce from there. So that is basically what a Fibonacci projection means, right? I'm going to erase erase it over here. I'm going to draw it again for you. Very simply, Fibonacci projection means that you're taking the distance from, if you have a movement like this, you're taking this movement. It could be 100 pips, and you're projecting it over here, maybe another 100 pips. This is what I mean by a 100% Fibonacci projection over here, right? So we have stuff like the 100%, we have the 61% projection, we got the 78% projection. All of it basically means that, you're taking the distance and you're multiplying it by 61, 78, or 100, right? When you're forecasting when the reversal is going to happen. That is the meaning of Fibonacci projection. Now let's talk about Fibonacci expansion. It kind of looks like the same thing, but you only have one starting point and one ending point. Price must minimally retrace at least 50%, minimally 50%. So if it retraces to 61 or 78, it's fine. What then happens is that you forecast price to go up to reverse off the negative 27% level, right? And you can see that has happened very nicely over here, right? So this is the trick to Fibonacci expansion, right? You are literally just forecasting when price is going to reverse, okay? You're literally just forecasting when price is going to reverse right here. Okay, it's a very, very important rule too, right? Because it is one of the few market leading indicators out there, right? It's one of the few market leading indicators to help you like forecast at what point in the future is price going to reverse. Very few other indicators are able to do that. Okay, guys. Now the last one I'll talk about is called Fibonacci extension, right? So Fibonacci extension, I call it like a Nike tick. You have your starting point of your Fibonacci retracement here and your ending point over here. It will then retrace two key levels, 127 and 161.8. Those are the important Fibonacci levels that you need to refer to. Okay, and once you rise up, right? Once you rise up to the 127 and 161, what happens is that price tends to reverse from that level. Okay, so that is what we call a Nike tick. Nike tick is very, very straightforward. Okay, it's a very, very straightforward setup, right? And you're looking to play the reversal from the 127% or the 161.8%. I'll be showing you some examples of this later. But the key thing here is that we have looked at Fibonacci retracement, extension, projection, and extension. The four Fibonacci, four types of Fibonacci. How we're going to use that is this concept called confluence. Okay, it's this concept called confluence, right? So as you can see, we can start with the Fibonacci projection, 100%. We can start the Fibonacci retracement, expansion, extension, and we found 1, 2, 3 reasons why price might bounce off this area. So this is the meaning of confluence, right? You line all of them up together, it creates a nice area. And what happens is that when price tests that level, tests the area, it tends to reverse very nicely, right? Because you have not only 1, but you have 2 and 3 reasons why price might bounce from that level. Okay, so that is the concept of Fibonacci confluence, right? You don't just trade it you don't just use a single Fibonacci to trade it. You combine multiple of them together to be able to execute the trade, right? Usually it's a reversal trade. Okay, guys. Now let's look at some examples, right? So we take some time to look at a couple of examples on using Fibonacci confluence. Okay. Just I probably need to turn off my video over here just so that it doesn't mess with the charts. Sorry, just let me load this. Let me just make a copy, right? Okay, let me show you some examples of Fibonacci confluence. We try to look for them together. Oh, sorry. We try to look for them together, okay? So I usually have my Fibonacci retracements when I draw it. I have this thing, all the different Fibonacci levels over there. When I use all fibs, okay, when I use all fibs, it actually shows me everything. So over here, the middle part is what I call Fibonacci retracement. And once it retraces beyond the 100%, this is what we call Fibonacci extension, EXT. And if it comes down here and it comes further down, this is what we call Fibonacci expansion. Okay, these are the three types of Fibonacci, right? We got the retracement, we got the extension, and we got the expansion. And these three will actually unlock a lot of the key secrets, so how you can call reversals. Okay, let's take a look at some examples. We're looking at euro dollar now. Actually, let's look at pound dollar. When you draw a Fibonacci here to here, what do you notice, right? I'm just going to highlight one key level, 127%. You would notice I'm going to do a bar replay feature over here, right? That price actually went all the way up, right? Price went all the way down. It went all the way up. It touched the 127% and it retraced back to the 100%. This is a very, very good trading strategy, which I use by myself, right? I use myself and I reached a decent amount of profit, right? I see if I have the picture over here, right? But basically, just let me see if I have it. There you go. You know, it's a good 8% that we made over here already. So as you can see, let's do a save as a detailed report. Yep, detailed report. There you go, right? Yeah, basically it's a good amount of trades that you see over here, right? You got about 8% profit, right? With a 2% drawdown. It's enough to 2.7% drawdown, 80% win rate for short position, 50% win rate for long positions, right? Right. Most of our trades were profitable, 65%. So it's a nice 65% hit rate, right? Pretty good risk reward. Like average profit is 1147, average loss is 920. So you know, managed to make pretty good, decent money with this setup. Okay. Now it is the setups I took was purely from here, right? We take the reversal of the 127 and play it down to the 100%. Okay. Now the success of this strategy lies in confluence. Sorry, just give me a second. The success of this strategy lies in confluence. Okay, what do I mean by confluence? In this particular setup, right? If I were to do a bar replay feature, so I think it was a 4-hour chart. Right, in this particular setup, when we did the Fibonacci retracement, Fibonacci extension, I noticed there's a 127 over here. The 127 also happened to line up with this swing high resistance. Okay, this multiple swing high resistance, meaning that I have 127, I got one swing high, I got two swing high. So it's a high enough chance, you know, we got one, we got two, we got three reasons why price might touch this level and reverse. Okay, we got three reasons why price might touch this level and reverse. And true enough, from there, right, let's go bar by bar. Right, price actually comes up here, touches this level, and reverses very nicely. You can see it reversed and it reached our 100%. So this is what I call the Nike tick strategy. Right, you're really just looking to play the reversal of 127 all the way down to 100. How you can improve this strategy is one of it, of course, having a very clear Nike tick, right, very clear V that you're looking for. The other is when you combine it with support and resistance. In this case, we got swing high, right? Price reacted once, reacted twice. when price finally came up again, it was going to react again. So there were 3 reasons why price was going to drop. Okay, combine that at 127% extension, the Nike tick kind of Fibonacci extension, you got even higher probability trading strategy. Okay, now of course you can combine it with different forms of Fibonacci. Let's try to see if I can find any over here. Let's see. I'm trying to find one with a little bit of a Fibonacci projection too. Let me see if I can find a good example with one with a Fibonacci projection. Okay, this is one example. This is one example over here. So let me just make sure I get this right. So as you can see over here, right, very nice Fibonacci extension. This is a nice little Nike tick that you're looking at, right? You can see it's a very, very nice Nike tick. And it comes all the way up to here, this 127. Okay, I'm going to leave this 127% over here. Because at the same time, there's a very nice Fibonacci expansion, right? Remember the rule for Fibonacci expansion. The rule for Fibonacci expansion is that price needs to minimally retrace 50% of the entire move, right, before you can consider a bounce, right? So we got over here 1 to 7 and negative 27. So what we call a confluence area. This is a confluence area. Okay, so what then happens is that we wait for price to reverse from this level and play the move down all the way down to here. This would be where we play the reversal from and until. Okay, so here we go, right? So we can see price, bar by bar, it starts to reverse, There we go. And price will have hit our take profit then. Okay, it's a simple enough reversal that you're looking for, but you notice that I will not trade based on the 127 alone. I mean, based on 127 over here, right, a zigzag Nike tick, right, 127 is already pretty strong, right? But if you throw in this Fibonacci expansion with a negative 27 up here, them combined, right, actually causes, it gives you a much more higher probability setup. Okay. Now, if you really want to really improve your probability of you getting a good trade, I believe you could throw in a little bit of RSI. Because you can see over here for the RSI, right, when price was starting to do the reversal at the key level, right, it was a bearish divergence. Bearish divergence. And bearish divergence is when the price, the highs of the price is going higher, means it's climbing, right? And in this case, stochastic RSI is going down. So in this example, right, it's a bearish divergence, right? We have not only the 127, we have not only the negative 27, right? We also have a bearish divergence versus stochastic, no, versus RSI. So that gives you a good probability that price is gonna drop. Okay. Okay, I see a couple more people over here, right? Let's see, Mr. John, right? Yosef, right? Damir, Mr. Damir, are you around? I just want to make sure that you can hear me clearly. Right? If you can hear me clearly, feel free to send a message in the chat. All right, Mr. Damir. Right? Okay. Let's continue today's session. Right? So this is an example of finding a Fibonacci expansion along with a Fibonacci extension. So this is expansion plus extension plus divergence. Okay. All three of it lining up very nicely to call this reversal over here. Okay. Let me try to look for a couple more examples. Right. So we got Kiwi dollar. Okay, there we go. This example, I should be able to show you a little bit more confluence over here. So I tend to look out I tend to use the Fibonacci extension as the leading indicator of what might happen. So the Fibonacci extension usually works when you start to spot a letter V. Whether it's a V or inverse letter V, the moment you see it, right, it is time for you to start mapping out your Fibonacci extension, right? So the moment I notice this letter V over here, whether it's an inverse V, I start drawing a Fibonacci retracement from one place to another place. Okay, now that it's over here, what I then do is I will highlight the 127% Fibonacci extension over here. Okay, so we're looking for the reversal of a price to come all the way down to here, touch this 127 and come back up to the 100%. Okay, it sounds like a simple enough setup, but if you get it wrong, it can be very dangerous. Okay, so 127 over there. Okay, let's see how price actually panned out. Bar by bar, you can see it go down, go down, go down, go down, go down. It touched the entry, right? And it bounced back up to the 100%. It might even bounce before that, but yeah, it bounced up to the 100%, right? You see it come down, touch the 127, then it do a small little nice bounce. So this move is all you need to make money, right? You don't care about what happens after that, but this move is all you need to make money. Okay, so that's another example of using the 127 Fibonacci extension, right? I'm going to try to find an example for you where there's a Fibonacci projection. Okay, we got another example over here. Okay, in this example, right, we can see that price is starting to create a nice little ladder V, right? As you can see over here, right? It's starting to rise up nicely and it's starting to reverse. Okay, we look at the 127% extension over here and we're like, okay, looks interesting. I then do a Fibonacci projection with this as the top, the middle, the ending point. What we then notice, right, I'm just going to remove everything and leave the 127 over there, is that there is a 127 and there's a 78.6 Fibonacci projection, right? So it's all lining up over here, this area over here. That means my pending order will be in this region, okay? What happens when it's like this, right? We can see, let's show you. Price pass, touches that level, and it bounces back up, right? So you have been able to play this little bounce here making you a fair bit of money, right? So it's all about finding the extension level and combining it with like other forms of technical analysis. You can use the Fibonacci projection, you can use a Fibonacci expansion, and you can use a Fibonacci retracement. So if you were to use a Fibonacci retracement in this circumstance, let me see if it works out. Usually it's a lot harder. Yes, usually a lot harder. Yeah, okay. We'll leave that out. Okay, so that is a great example of using Fibonacci extension with Fibonacci projection, right? I'm going to go through a couple more examples, guys. If you have questions, please ask them, right? Don't hesitate to ask them, all right? Try and find a few other good examples of Fibonacci. There we go, right? This is another really, really nice example, which might just line up with a bigger retracement story. Nope, right? But it might line up on the shorter term time frame. Let me see. You can see that price actually goes all the way down over here, and it's starting to form a nice little Nike tick, right? And it actually comes all the way here, touch the 127, right? And then reverse back down to the 100%. Okay, so this is another example of using a Fibonacci extension. The trick, guys, is really in finding the tick. It's not easy to find the tick, but once you find the tick, you know, you're a lot trading is a lot easier for you, right? The trick is really in finding the tick. Let me see, even in such a situation, can you find a tick? Yes, you can, right? And if you can find the tick, you probably can find the extension. Okay, you can find that. Okay, let me show you another example, a really, really good example. Okay. We can see price over here, right? It looks like it's gonna form a nice little reverse Nike tick. Okay, so we take a Fibonacci retracement, we start from the bottom here and to the top. Okay, we got a nice 127% Fibonacci extension about there. At the same time, you know, you have a nice little Fibonacci expansion, price goes down, retraces minimally 50%, right? But it doesn't kill you off completely. You know, so here you go, retrace minimally 50%. In this case, it retraces all the way up to here, then looking for the move down. Okay, so here we go. Here, touch the 78.6, and we can see a negative 27% all the way down to here. This lines up with a 127% Fibonacci extension too. And of course, we got one more level, which is the major Fibonacci projection, right? From here, all the way down, all the way up. And we have a 61.8 Fibonacci projection here. So we got 1, 2, 3. We got 1, 2, 3 reasons why price might bounce, right? So we're going to highlight this area over here. Okay, I'm going to highlight this area over here. And what we're expecting is for price to actually come down, touch this level, and bounce up minimally to this level where it kind of broke out from. Okay, and this happens way too often, right? We can actually see price come down, come down, come down. Test that level. And then it bounced up, as you can see over here. It bounced up and it kind of hit this take profit. Okay, this is one of the beauties of Fibonacci confluence, right? You find an extension, you find a retracement, you find a projection, you find an expansion, extension, right? All of it lining up together, at least 3 of them lining up together. It gives you a really good setup where you can play a small little bounce from the entry to the breakout level, the 100% where you were at. Okay, guys, you know, you can combine this with support and resistance. You can combine this with trend lines. You can also combine this with Fibonacci, right? So the key is what I call Fibonacci confluence, try to at least find two. You can find two that lines up is great, right? So you got your Fibonacci extension, right? You got Fibonacci retracement over here. You got Fibonacci expansion, and you got Fibonacci projection. Okay, this fall you minimally must have two. I usually like to find retracements with projections. They tend to work very well. I like to find extensions with projections too. Okay, I really like to find extensions with projections when they line up over here. 127 and the 61.8 usually works out quite well. Projections and retracements work quite well. Extensions and retracements also work out quite well, right? And of course, extension and expansions tend to work a little bit less, right? But they can work out well. As a supporting argument, if you get expansion after having the rest, right, it's worth consideration, but I will not use it by itself, right? So I kind of put this maybe in red. Yeah. So if it's a expansion with anything else, it's not effective. But if an expansion as a supplement to the other Fibonacci's, right, it's actually a pretty good setup. Okay. Now, guys, I spent a good 40 minutes explaining Fibonacci to you guys. I'm just going to open the floor for 1 minute for anyone who has questions regarding today's webinar. Right? Does anyone have questions regarding today's webinar? Okay, so now that I'm moving away from from the slides, no, from the charts. Turn on my video again. Does anyone have any questions regarding today's webinar? Right, if you know how to master Fibonacci well, it will really help you when you're finding confluence. You know, when finding reversal, it's very effective in finding reversals, less effective in finding breakouts. Okay, now. Okay, I can see that, you know, there's not many questions coming through, and I appreciate that. I hope the explanation was clear for you guys, right? Thanks for taking the time to come to today's webinar, right? I hope you found today's session useful. Apply in your trading, whether it's any form of retrace Fibonacci, if you can use it to combine and find areas of confluence, not only with Fibonacci, but with other support and resistance, with other price action levels, right? You can actually come up with a very good trading strategy. Okay. Now, that's it for me, guys, today. Thank you very much for staying throughout, right? If you have no questions, end today's session. I'll catch you tomorrow for a live trading session. Stay safe, trade safe, and I'll catch you guys tomorrow and next week.